Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at what might be next for Apple, Amazon, and Facebook in the year 2020, which is still crazy to say. But before we get into everything, I want to just remind people that if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So we're going to start by saying that, as most of you probably know, the markets continue to climb to new highs. The Dow, S&P 500, and NASDAQ all jumped to new highs Friday. And this comes as outward tensions between the U.S. and Iran have slowly eased, and this came after President Trump's speech on Wednesday. And then on top of that, China's Commerce Ministry said late last week that its chief trade negotiator is set to travel to Washington early this week to sign the so-called Phase 1 trade deal. And then on top of these positive geopolitical and macroeconomic signs, last week, stocks look to be in a solid position to continue their 2019 climb in 2020 for an array of reasons. This includes historically low U.S. unemployment, low interest rates, and a projected to return to corporate earnings growth. On top of that, some of last year's run was still simply a function of that late 2018 sell-off, so this could give stocks even more room to climb in 2020. So based on all of this, we're going to look at three stocks that help move the market in general, Apple being one of the stocks that helps really push this whole bull run along over the last decade plus at this point. So we're going to start by taking a look at Apple, and then we're going to go ahead to Amazon and then close out with Facebook today. So Apple shares have skyrocketed over 100% in the last year. This has crushed the S&P 500, and it's blown away all of its so-called FANG peers. And it also hit a brand new high on Friday and Monday morning as well. So we're just going to kind of roll through the basic pitch for Apple to its potential shareholders, and then we're going to go forward with some more fundamentals and then take a look at what to expect. So Apple really is a $1 trillion company today, thanks in large part to its success with its iPhone and its ability to continue to sell those high-price tech devices in a more crowded marketplace than ever before. And they're able to do that because its value, its brand has value in that cachet. So Forbes, it's listed as Forbes' number one most valuable brand in the world. This is ahead of obviously all the other tech companies and ahead of the likes of McDonald's and Disney. And CEO Tim Cook and the company have been able to really cultivate that loyal customer base and that have people who are willing to pay over $1,000 for a new iPhone, even though over the last several years, many tech enthusiasts would argue that there's fewer game-changing updates than ever before. And then over the last several years, Apple has been able to bolster its non-iPhone business, which is a good thing for investors. And this includes wearables. So that's its smartwatches, which is the Apple Watch, its new widely popular AirPod headphones that you see everywhere. And then also on top of that, it's their services segment that has really been that standout over the last several years. And this includes its App Store, its Spotify challenger, Apple Music. It also includes a new Apple credit card it rolled out in partnership with MasterCard and Goldman Sachs, a new magazine-heavy subscription service for news, Apple Arcade, which is a subscription-based video game service, and then the big buzzworthy streaming or service business is their new streaming service, Apple TV Plus, which debuted in early November of 2019, that's now hoping to compete alongside Netflix, Disney, Amazon, and all of these other companies in this more crowded than ever streaming space. So that's where their services business stands. And Apple's general goal is that it wants to generate more revenue from its roughly 1 billion active devices. So they're just trying to get more people who are using their devices to spend more money on these various services as well. So if we look back, the company's services unit climbed 18% last quarter, which was Q4 of 2019, and 17% for the year overall in 2019. So it climbed 17% last year to account for nearly 20% of total revenues, which made it easily the second largest business for Apple behind the iPhone, which is at about 55% of sales in 2019. And this more than doubled Mac and iPad combined. And we should note that despite this massive run of over 100% growth over the last year, Apple's 2019 sales did slip about 2%. And this came really largely due to the back of hard to compare period in 2018, where its sales were up 16%. So if we look ahead, our estimates are calling for Apple's fiscal 2020 sales, which is its current year, to climb about 6% to a whopping $275 billion. And this would be driven by about 16% services growth. And then if we look ahead to 2021, Apple sales are expected to then climb another 8% above that. So we're calling for 6% growth this year and 8% growth in 2021 to see it hit almost $300 billion in revenue. And then along with that, we're calling for Apple to post some adjusted earnings growth of about 10% this year and then another 16% next year. So some solid top and bottom line growth we're calling for this year and next year, along with all of its plans to continue its services business expansion. And its AirPods are, as I said, more popular than ever. So that wearable business has grown as well. So right now, Apple stock is currently a Zacks rank number 2 buy based on some solid positive upward earnings estimate revisions and also the Phase 1 U.S.-China trade deal, if that officially goes through, will help give Wall Street investors even more confidence in Apple and some of these other tech companies that have operations in China. And overall, analysts, and it seems like many users have been pretty pleased with the iPhone 11, which is the new model that rolled out this past fall. And Apple executives have mentioned that they're pretty happy with their sales so far. But then if we look ahead to the fall of 2020, this is when analysts and some people who you read who are Apple they follow Apple and speculate on what's going to happen. They expect that the next iPhone, which would be whatever they're going to call the iPhone 12, will be some of their biggest updates in years. So this is going to be maybe a big year for the iPhone, but who knows? They say every year is going to be the next time they have the biggest updates. But supposedly the iPhone 12, which is going to be due out in the fall of 2020, will be its kind of biggest jump in some time. So with that said, some investors might want to wait for Apple to cool off a bit, but really at this point, who knows when that will be, as Apple sits at its yet another 52-week and all-time high. Apple is trading at about 22.7 times forward 12-month earnings, which, as some might expect, this also marks a new high for over the last year, and it comes well above its median, but it is trading not too far above just the S&P 500 in general, which is also trading at its new highs. So its valuation is a little bit stretched, but in general, it seems like Apple is in a really solid position going forward. And if you're going to get into a stock, it seems like Apple's not a bad bet at this point going forward. But as I said, some people might want to wait for a little bit of a pullback. But in general, if you see the market going up in 2020, it seems like Apple will probably be a part of that run going forward. So now we're going to move on to another company that's kind of shaped the last decade of this bull run and looks like it will play another big role in the decade to come, and certainly in 2020, and that is Amazon. But unlike Apple, Amazon's kind of slowed down a little bit over the last year. So Amazon stock has actually fallen 6% in the past 6 months. And this is while the S&P 500 has climbed. And overall, Amazon's up just about 15% in the last year, which falls behind the S&P 500 and way behind Apple's massive climb. So over the last year, this, you could call it, especially for Amazon standards, this downturn has come as the company's invested pretty heavily in its one-day shipping program for Prime members. And this comes as it tries to fight back against the likes of Walmart, Target, and other traditional brick and mortar retailers that have found their own e-commerce success, which was driven by Amazon's success. So it's good to see, especially for consumers, that Walmart and Target and Costco have been able to successfully roll out their own digital and e-commerce and delivery initiatives that have prompted Amazon to give consumers even quicker delivery times. So they've spent heavily on this one-day shipping, and this is something that Jeff Bezos and Amazon see as vital going forward, even though it's hit a little bit of the bottom line recently. So last quarter, Amazon posted its first year-over-year quarterly earnings decline since 2017, with its adjusted earnings per share figure down about 26% in Q3, and it also fell well short of our Zacks estimates. And this came after Amazon missed bottom line estimates in the second quarter, which also ended a streak of record quarterly profits. So Amazon had been on an impressive streak in terms of its bottom line growth, but then the last 2 quarters have seen it slip a little bit. But as I mentioned, that's mostly based on its spending on trying to roll out one-day shipping from its previous Prime, which was 2-day shipping. So we should note, though, specifically, its worldwide shipping costs, just to put things in perspective, climbed about 50% last quarter. So that's where all that's coming in. And as I mentioned, this is to help fight back against Walmart, Target, and all of those other companies. So this is just a quick quote from Bezos last quarter, noting that why they're making this transition. It puts fulfillment centers very close to the customers, which could help lower costs down the road. And then he noted in prepared Q3 remarks that, quote, customers love the transition of Prime from 2 days to 1 day. They've already ordered billions of items with free 1-day delivery this year. It's a big investment, and it's the right long-term decision for our customers. So they really see this as probably just as a blip on the radar. They're going to spend a lot of money now to really see this payoff going forward. And we should also note that along with its e-commerce business, that its cloud computing business, which is known as Amazon Web Services, or AWS, has continued to thrive. That revenue surged 35% last quarter, but that was down a little bit from where it had been in recent periods. And to help make up for some of that slowdown in AWS growth, the firm's advertising business, which they refer to, if you're looking at their quarterly reports, that's in their other category, but that's mostly their advertising business, that saw its sales climb 45% last quarter. And to put things into perspective, Amazon is now projected to grab the 3rd largest share of U.S. digital advertising dollars in 2019. So last year, this is behind only Facebook and Google. And going forward, AWS's continued success is going to help, because it's a higher margin business, help them jump into everything from more of a logistics push into pharmaceuticals and more. And like everybody else, seemingly these days, Amazon is also prepared to compete. And it's been a little bit more quiet, I'd say, compete against Netflix, Disney, and Apple in this streaming TV age. And they also have their own Spotify competitor as well. And we should note that Amazon shares are trading at about 8% off their 52-week highs. And Not too long ago, in about mid-December, they were down 15% off their 52-week highs, and then they've gone on a nice run over the last several weeks. And as one might expect, with a little bit of a downturn over the last year, Amazon's valuation picture looks a little more favorable. Amazon is currently trading at about 2.8 times forward 12-month sales estimates, which marks a discount against the S&P 500 and its own 2-year median of 2.9 and its high of about 3.7 over that stretch. So its valuation picture is more solid than ever. It's sitting at about 8% discount compared to its 52-week highs. So this kind of sets up Amazon to possibly go on a solid run in 2020. So if we look ahead now to our estimates for Amazon, we're calling for its adjusted fourth quarter earnings to slip about 34%, as we mentioned. That's that spending to beef up its shipping infrastructure. This would mark a larger downturn than last quarter. But if we look ahead, overall, their earnings per share in 2019 are expected to climb about 2%. With then, if we look ahead to 2020, that figure is expected to climb about 30%. So a little bit of downturn over the last several quarters going into Q4, but then a comeback in 2020 in terms of earnings growth. And then on the top line, we're calling for Q4 revenues to jump 19% with full year fiscal 2019 revenues set to climb 20% as well. And then if we look ahead to 2020, we're calling for another 19% growth on the bottom line. And this 19% growth can sound small considering where Amazon had been relatively recently, but they're expected to add another $52 billion to their top line in 2020 to reach a whopping $331 billion in 2020. But as I mentioned, 2019 and 2020 would mark a bit of a slowdown compared to where it had been over the last several years, where it had posted consistent top-line growth of around 30%. But this isn't totally new territory for Amazon. This growth in 2019 and 2020 would roughly match their growth they saw from 2013 to 2015. So just kind of a slowdown compared to some recent periods, but nothing that's dramatically different from where Amazon had been over the last decade. And as I mentioned, the fact that it's only been up 15% over the last year, that looking ahead, it seems hard to imagine that Amazon stock won't regain some momentum going forward, but obviously crazier things have happened, and we should note that Amazon is currently a Zacks rank number 3 hold at the moment. And now we're going to close today with a look at Facebook, who has seen its shares climb about 52% in the last year, and this has easily outpaced all of its FANG peers except for Apple, which we talked about at the top of the show today. So this is way above Google, way above Amazon, and way above Netflix, which is down actually about 3% over the last year. And like Apple, Facebook hit a brand new high Friday and then also hit a brand new high Monday morning as well. And Facebook's pitch to Wall Street and investors remains relatively straightforward, with the obvious caveat that there's political backlash and there's the possibility of some government intervention down the road. But if you just understand that that's there, their business remains pretty solid at the moment. So Mark Zuckerberg's firm remains a pretty high margin digital advertising giant with a ton of cash. So despite all this political backlash over the last now several years at this point, Facebook's daily active users climbed 9% last quarter, and their monthly active users climbed about 9% as well. And so just for a frame of reference, their daily active users are about 1.6 billion, monthly active users 2.5 billion. And if you look at a whole, Facebook expects their executives say that roughly 2.7 billion people use at least one of what it calls its family of services each month. So this includes its namesake Facebook platform, WhatsApp, Messenger, and Instagram, which now at this point looks like a steal at buying that company for about $1 billion back in 2012. And going forward, Facebook is just their ability to have that many users in one place. It's too much for advertisers to pass up, despite all of this political backlash and the fact that this political backlash actually hasn't really done anything to its user growth. So Facebook is projected to grab about 22% of total U.S. digital ad spending in 2019, behind only Google and well ahead of what is now the third place company in that space, which is Amazon. So looking ahead, and these are broader trends as well that would tend to favor Facebook, that overall digital advertising is expected to grow from about 46% of the global total ad market in 2018 to over 60% by 2023. And this is according to eMarketer. So over 15% growth in overall digital advertising, or the market share from 46% to over 60% in about a 4 or 5 year stretch. So digital advertising is only expected to grow, and Facebook is one of these global giants in terms of digital advertising. And at the moment, they do make 99% of all of their sales from advertising. So obviously they are a little one-track minded in that sense, that they're not a super diversified company at this point, and they are trying to change that at the moment. But I mean, in a world where people are paying money to not see ads on Netflix or Spotify or anything like that, that Facebook is just going to become more and more valuable. But Zuckerberg and the company have tried to expand. This includes their Facebook Marketplace, which is kind of similar to a Craigslist / eBay / Amazon, where you can buy and sell. People individually can buy and sell in companies as well on Facebook Marketplace. They've also bolstered their streaming and live video push. As I mentioned, as part of this larger streaming business, they're trying to push into the music video rights game in an effort to challenge YouTube. And Zuckerberg has spoken very publicly about their wanting to get into the cryptocurrency world, which, despite some pushbacks and setbacks, it seems like Zuckerberg, if it is legal, does want to try that out at some point. But who knows? And at this point, it doesn't really matter if their whole business is digital advertising for the next 5 years. It seems like it'll be a really solid play. And we should note that the upcoming 2020 election cycle, which is obviously already underway, it's going to just become more and more newsworthy over this next 10 months or so, 11 months, and Zuckerberg will probably be in the news more than ever. So some investors might not like the fact that a company they're investing in will be probably having negative headlines on both sides of the aisle in the lead up to the 2020 presidential election. And this is also coming as Zuckerberg has said that they will continue to run uncensored political ads, which is standing in direct opposition to Twitter. And Zuckerberg was pretty adamant on their Q3 earnings call about why they're making this decision. They don't really want to be in the business of censoring anything in any way. But we're not going to get into too much more of that. They've already paid a historic $5 billion FTC fine, and they're currently under, along with other giants like Google, they're under some more antitrust reviews. So that's just the continued caveat that people, if you're considering investing in Facebook, you have to know that that is all going on at the moment. But despite all of that, and despite the fact that the stock is sitting right at its 52-week highs, Facebook is trading at about 24 times forward 12-month Zacks earning estimates, which represents a discount against its industry's 30 times forward earnings average and its own 2-year highs of about that same mark. So it's trading at a lower valuation than where it has even over the last several years. And we should note that the company ended last quarter with about $52.3 billion in cash and other marketable securities, and its operating margin was at 41%, down just 1% despite its higher spending over the last year. So if we look ahead, our estimates are calling for Facebook's fourth quarter sales to climb over 23%, with its overall 2019 revenues expected to climb over 26%. And then if we look ahead to 2020, we're calling for another about 22% growth in 2020 to see the company pull in about $86 billion. And it's important to note, like with Amazon, that these full year growth estimates do represent, well, unlike Amazon, but a slowdown compared to recent periods, but these would actually represent Facebook's slowest sales growth as a public firm. So for example, its 2018 sales were up 37%, 2017 up 47%, 2016 up 54%. So the growth we're calling for this year, which is 26%, and next year, which is 22%, would certainly mark a big slowdown compared to where they have been. But Wall Street and traders have obviously seen this slowdown coming and been willing to pay up for this stock compared to where it has traded a bit recently, and it's at new 52-week highs. So maybe this is just a new age for Facebook, and this slower growth is just going to be something that people are willing to accept. And then if we look on the bottom line, its adjusted earnings are expected to climb about 16% this year. And then if we look ahead to 2020, we're expecting 42% earnings growth in 2020. So some 16% growth this year and 42% growth in 2020 is what our estimates are calling for. So in the end, some investors really might want to stay away from Facebook because of all of the political uncertainty, especially during this 2020 election year, but that didn't stop Facebook from soaring back in 2019. So it'll be a fun stock to watch this year. And that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.